Good morning. On behalf of Cherry Bekaert Wealth Management, I'd like to welcome everyone to this morning's webinar on financial planning for executives approaching retirement. My name is Wes Watkins, and I'm a managing director at Cherry Bekaert Wealth Management, a division of Cherry Bekaert CPA firm and advisors. I've been with Cherry Bekaert for over 35 years and have been providing tax and financial planning services during this time. Also participating with me in this morning's presentation is Jeff Gump, a financial advisor and member of our wealth management team with over 20 years of experience. Our goal today is to inform you on our approach in assisting clients in planning their financial future and looking at the complexities which can arise as executives and others approach retirement. We feel the best way to accomplish this is to review a case study we've prepared where John seeks out financial planning assistance months before his targeted retirement. We anticipate our review of our case study will take 30 to 40 minutes. And just want to let you know that we've prepared this case study based on information and our experiences we've had over the years with various clients we've worked with. Many similarities. The names have been changed to protect the innocent. Before we get started with our case study, I believe you'll find it helpful for us to first review the components of financial planning and our approach to working with clients and providing these services. Although each component has a different primary objective, it's necessary to take into account all of the components when you're formulating a plan. And you may say, prior slide. You may say different primary objectives. And the answer is yes, different primary objectives. When we look at investment planning focuses on establishing and implementing an investment strategy based upon your goals, risk tolerance, time horizon, and other variables. Versus estate planning, which focuses on establishing a plan related to the disposition of your estate and orderly administration. Today, we'll be looking and reviewing a case study on financial independence planning, also referred to as retirement planning, which is really establishing your goals and assessing your ability to attain and maintain financial independence throughout your life. Other areas also include tax planning, risk management planning, etc. When working with a new client, we generally will start out in performing a financial planning, independence planning engagement, in that it allows us to gather all of the relevant information for a client and get to know them and get to understand their goals and objectives. We'd like to review with you our process, because when we talk about services and how we approach things and really helping to manage clients' expectations, our process, whether we're dealing with estate planning, financial independence planning, investment planning, our process is the same. And it is a goal-based process, which really starts out with working with clients and helping them to establish and document their goals, financial goals and other goals. With this process, the first step, after establishing the goals, we gather information from our clients, we compile that information, we analyze it, we evaluate it. And the third step of this process is for us to develop recommendations and alternatives, and that often there's not one right recommendation, but options to lay out, and to lay these out for clients to let them make informed decisions and the consequences of the actions they're considering taking. Upon adopting and developing this, we assist clients in implementing these recommendations. And lastly, monitoring these recommendations. And life, as everyone is aware, is not a static exercise. It's a very dynamic exercise. Goals change, facts change, situations change, and we, with financial independence planning and all of the other planning that we provide, we revisit this periodically as it relates to financial independence planning. Typically, we're revisiting every 2 or 3 years unless there have been major changes in goals or financial situation, in which case we would revisit it before that. So, in kicking off our case study this morning on independence planning, to orient you as to where we're starting, we have met with the client, had 2 prior meetings. So you'll note on the right side of the slide that we've established the client's goals. We've analyzed and evaluated and obtained the information that we had requested to allow us to develop recommendations, which we have pulled together and will be reviewing today. So having said that, I will turn it over to Jeff to begin the case study.
Great, thank you, Wes. Again, let me just kind of give some details on our fictitious clients, John and Mary Smith. Mary is 68 years old. She retired 3 years ago. John is currently 65 years old, and he's a C-suite executive at XYZ Corporation. John also has a daughter, Beth, who's 38. Beth has no kids. She is happily married, but it doesn't look like kids are in the future. And even though it's John's daughter, Mary treats her basically like her daughter also, and is very important in her life. So really, when you look at this slide, we really help clients kind of categorize their goals into needs, wants, and wishes. And again, as Wes said in our first meeting when we sat down with John and Mary, they laid out the 5 things that fit into these different categories. The first one is their basic living expenses. And then the second one you'll see is healthcare. We do break those out from a cost perspective because you'll see the historical inflation rate. Well, right now it's averaging about 2% on living expenses, or a little more, but it's been as high as 3%. So we typically like to build in roughly a 3% inflation rate. Now in healthcare, it has a much higher inflation rate, closer to 6%. So we like to break that out and have that higher 6% figure in there. And I also kind of want to point out, in one of our previous sessions, we went over the mortality tables with John and Mary, and they're both very healthy. They have great family history. So looking at that, we came to a decision that we were going to use their average life expectancy, but we're going to add 5 years just to be safe. So that really has Mary living till 94 in this plan, and it has John living till 2047, or when he is 92 years old. So if John was to retire, as you see, the analysis here we're running on the basic living expenses at 66, we'd be planning for 26 years of retirement. Now, again, also in one of those previous meetings, we went over their budget in detail, and we projected they need roughly $15,000 a month in living expenses. They also have some big expenses, property tax, homeowners insurance on their primary residence, and also their vacation home. And they also have pretty hefty long-term care insurance premiums that are annual and due each year. So we basically projected that $15,000 a month plus those large ticket items. They need about $200,000 a year to live on. I do want to point out it's great that they have the long-term care insurance, because if they did not, we'd also have a planning module in here under needs to potentially self-insure those costs down the line. Now, if you look at the wants, it was very important to Mary that they take trips. She's been planning 5 big trips all over the world, but John's just too busy at work to take them. So she's really itching for John to retire so they can take those trips. You'll see she's projecting at roughly $20,000 a year, and we have that happening 5 times in the first 5 years that they retire. And then the other thing that's very important to them, currently they're giving $15,000 a year as an annual gift to their daughter, Beth, usually around Christmas, and they want to make sure they can still afford to continue to do that, and that's important to them, so we have it under wants. Now, the last thing you see down here is wishes. Mary would really like to do some major renovations to their primary residence in Richmond, and also their vacation home up in the Shenandoah Mountains, and both of those the estimates they have will cost about $500,000. But even though Mary would like to do that, she doesn't want it to stop John from retiring so they can do those trips around the world. Now, again, these 5 things are what were important to John and Mary, but other clients we plan with, certainly education's a big goal we plan for, whether it be private schools or colleges, weddings, And again, we see those numbers anywhere from 25,000 to 10 times that number at 250,000. Legacy, leaving a legacy is important to a lot of people. Certain charities, maybe their college or alma mater. Major purchases, things like RVs, boats, maybe vacation homes. And then potentially maybe providing care for their parents, or maybe special needs kids or special needs grandchildren. So now we're going to go ahead and look at their other sources of income. A lot of our parents or grandparents, they had the three-legged stool of retirement, which, 1/3 of your retirement income came from a pension, another third came from Social Security, and then the last third came from your savings or assets. Unfortunately, in today's world, only about less than a third of Americans have a pension. But as you'll see here, John and Mary are very lucky. They both do have pensions. Mary's pension is $18,000 a year, and it's going to inflate at 3%. John has a very generous pension of $119,000 a year, but it has no cost of living adjustment. And then we jump down to Social Security. Again, this a lot of times can be its own engagement with all the different strategies out there. With John and Mary, it was a little simpler because Mary already turned on her benefit at 66 years old, which was her full retirement age. So she's currently collecting $18,250 a year. Now, in John's case, we ran different scenarios, but we ended up recommending that he go ahead and delay collecting Social Security and wait till he's 70 years old, instead of collecting it at his full retirement age of 66 years and 2 months. By doing that, he's capturing 4 years of the delayed retirement credit, which is basically 8% a year, simple interest. And by doing that, instead of collecting at 66 and 2 months, which is full retirement age, and waiting till 70, he gets roughly 130% of that full retirement benefit that he would have got at 66, which is $49,362. Why that's very important is John passed first, Mary would be able to take over his survivor benefit, or take over his benefit of $49,000, which is a much higher amount. So now we're going to look at the third stool of which is savings and assets. So here you see the asset detail, but I just want to point out we do put in the specific positions that clients have, whether it be stocks, bonds, or mutual funds. And that's important because it helps create accurate assumptions for returns and volatilities later on in the planning. So you'll see here they have a joint account at Charles Schwab that's $642,000. Mary has an IRA at Charles Schwab, which is $110,000. John's 401k at XYZ Corporation is roughly $1.3 million. He's also adding $35,000 a year to that. He also has a deferred compensation plan that is currently valued at $682,000, and he's making additions of $112,000 a year. And then he has a corporate stock plan that's roughly another $100,000. So their total investment assets are roughly $2.9 million. You also see here, and Wes is going to touch in detail on this later on, he has stock options that are currently valued at $133,000. And that's basically the shares that he has vested divided by the current price of XYZ Corporation. At the bottom, you'll see their other assets. Their primary residence in Virginia is worth roughly $750,000. And then their vacation home in the mountains, out in the Shenandoah Mountains, is roughly $420,000. So the real estate's worth roughly $1.2 million. Now on this page, we just quickly summarize the prior page. Their net worth is roughly $4.2 million. They have $3 million in investments and $1.2 million in real estate. I just want to point out, you'll see they have no liabilities. So John and Mary definitely lived within their means. They were savers. They paid down their mortgages. They were able to buy the vacation home with cash. And the other thing I just want to point out real quick on this slide, the $1.2 million they have in real estate in the 2 homes, we're not using that in the planning at all, meaning we're not using that money to help fund the goals. So now we're going to go ahead, and again, as I said, when we inputted those individual positions, it really helps us look at a snapshot of their investment portfolio, and we get accurate data or information. So on the top left corner, you'll see it's only 2.8 million instead of that 3 million or almost 2.9 million. And that's because it's not including the $133,000 in stock options because they have not been executed yet. So quickly looking at this, and when I look at the left side here, the asset classes and the percentage in each asset class, it's definitely some concerns we need to look at. It's a very aggressive portfolio for where they're at in their stage in life, and it lacks diversification. The 2% in bonds, which is more the stabilizer of the portfolio, and it's 98% in stocks, which have a lot of volatility that comes with that. They also, if you look at that 98% that's in stocks, most of it's concentrated in the two areas: large cap growth and domestic equities. And then even if you drill down more, maybe even adds concern to the equation, is a lot of that domestic equity position is concentrated in John's company stock of XYZ Corp. So now if we look in the top right corner, we really look at historical returns, and you see it's from 1995 to 2019 of the portfolio they currently own. So all of us would love to have that roughly 10% return, or 7% if you take real rate of return when you back out the 3% for inflation. But to get those great long-term returns, it's not free. The trade-off for getting great long-term returns is you take on a lot of short-term volatility. You certainly see that here, as this portfolio's worst one-year loss is down 37%. And if you go back and look at the last elongated bear market we had, which was late in 07 to early in 09, this portfolio is down 50%. So to put that another way, if John was to retire in October of 07, his $2.8 million 16 months later in March of 2009, instead of being $2.8 million, would be $1.4 million. And that's certainly a concern, and Wes is going to address that later on in his recommendations. So this slide really, and it's got a lot going on here, so I'm going to do my best to break it down. With those multiple meetings, we definitely help the clients quantify their goals, and now we let the software really help us figure out probabilities of them achieving their wants, needs, and wishes. And to do that, we use 3 different calculations. There's an average return calculation, there's a bad timing calculation, and then there's a Monte Carlo simulation calculation. So the average return is a straight line calculation that really determines that they have enough money to fully fund their goals. And if they don't have enough money, it gives you the percentage of those goals that they can fund. Now, the bad timing calculation is also a straight line calculation. And what it basically does is it applies bad returns to the first 2 years of, in this case, when John retires. So that's the kind of the worst case scenario from a planning perspective. And then last but not least is the Monte Carlo simulation. And this is a statistical probability. First, it's a dynamic forecasting model that shows statistical probability using historical market returns. And basically, they take 1,000 different random periods or iterations to figure out their likelihood of success. So now that we've covered the 3 different calculations, we've ran 2 scenarios for them. Scenario 1 is on the left, and scenario 2 is on the right. So let's concentrate on scenario 1, the one on the left. And that's, again, their needs and wants, which is, their basic living expenses, their health care, their travel, the 5 trips, and then the $15,000 a year to their daughter. So looking at this scenario, if we use the average return calculation, they 100% successfully fund all those goals. And when John passes in 2047 at 92 years old, there's $5.9 million left in the estate. If we use the bad timing calculation, which you'll see down at the bottom, in the first year, the portfolio is down 7%. In the second year, the portfolio is down 32%. So a big downturn right out of the box. It still funds 100% of the goals, but only $4.2 million is left when John passes at 92 in this scenario. Now, if we drop down to the Monte Carlo simulation, which again is a more dynamic statistical forecasting model, their probabilities of success of reaching the goal is 91%, Or another way to look at it, if they had 1,000 lifetimes, 910 of them, they would be successful in the plan. So that's scenario one. If we jump over to scenario two, that's basically scenario one, but we're adding on Mary's wish for the $500,000 in house renovations. Now under this, you'll see the average return. They still fund 100% of all 5 of those goals. And when John's passing to 92, there's $4 million left in the plan. If we look at bad timing, where the first year is down 4.54%, the second year is down 33%. You might question, why is that different than the scenario one? That's because we took a big chunk of money out, the $500,000 right away, so there's less money there. So going back to bad timing, we still fund 100%, but there's only $1.1 million left at John's passing to 92. And another way to really think of that is that's a safety margin. And again, all those numbers I gave you on money's left, that's in current dollars. So I'm not inflating that out. It's just typically a little easier to understand when you're talking about current dollars. So if we jump down to scenario two, which is allowing Mary to get those homes renovated, there's an 82% success probability of success, or again, if they had 1,000 lifetimes, 820 of them, they'd be successful. We really like to see that number above 80 or in the green zone. So that's a good sign. I'm now going to turn the baton back over to Wes. He's going to cover John's employee benefits and the recommendations we have.
Thank you, Jeff. John, as an executive of XYZ Corporation, which is a publicly traded corporation, has what we tend to see as a standard benefits package for an executive, which is a stock option plan, the ability to participate in that, in addition to a restricted stock plan and a deferred income plan. And with each of these plans, there are complexities that come along with them that John should have been addressing over the years. And for the average person, it really does take professional guidance to sort of work through understanding the different plans and the actions and considerations to be taken. So starting off with John's stock option plan, you'll see on the top half of this slide, this is showing John having 7,996 options, which he has been granted. A portion of them he was granted in 2015, a portion of them granted in 2016. What you'll notice is they are all vested, but John has not exercised these options, meaning he has not exercised them and acquired the stock. And what you'll see in the top right-hand corner of the screen really is the pre-tax value based on the current market value of $43.08 a share, bringing it to the value of the options to $133,000. But understanding that upon exercising these options, they'll be subject to income tax as taxed as ordinary income, leaving an after-tax value, again, based on current market value of $80,000. What you'll also notice on the top half is an expiration date, February of 24 for a portion of them and February of 2025. What John was unaware of or is unaware of is that based upon the terms of the stock option plan, upon retirement, the expiration date of these options gets accelerated to a 90-day period, meaning that within 90 days of retirement, John has got to exercise these options or they will expire. My experience has been with most clients, they are unaware of the standard, and again, you have to look at the specific plan, but they assume that the expiration date does not change upon retirement, and the reality is it does, which forces some decisions to be made from a planning standpoint. The bottom half of the screen I'm not going to go into, but basically shows, and it's how we illustrate to clients, what the volatility of the stock, what the impact could be on options should they not exercise. But the takeaway here is John's got to make some decisions, because should he retire at the end of this year or decide to push it to next year, some important decisions to be made. As it relates to John's restricted stock plan, John has 2,300 shares of restricted stock that are vested. And these 2,300 shares that are vested, you may have noticed on the net worth detail that Jeff reviewed, we had a restricted stock account or included in that is XYZ stock, which are those vested shares. In 2022, John will vest in another 2,500 shares, and in 2023, another 2,800 shares. And the important takeaway from this is for John to understand that should he decide to retire at the end of this year, 2021, he will basically forfeit the and not vest in the future shares in 2022, 2023. Those benefits will be lost. Again, another important decision to take for John to take into consideration. So in summary, in looking and reviewing our recommendations, next slide, please. We've started out with looking and assisting John and Mary with financial independence planning. And again, the objective of this planning is to assist them in ascertaining, based on their current assets, income, and goals, that they will be able to effectively remain financially independent throughout their life. And in changing nothing, there's a reasonable probability that they are in good shape. Now, having said that, in reviewing their plan, their information, their assets, we do have recommendations that we feel they need to address, which are coming out of our financial planning engagement. First and foremost, and with most clients, there's always a list of things that need to be addressed, but we try to prioritize them in that for most clients, it's hard to digest multiple moving pieces, which are complex, and make decisions all at the same time. So we try to break it down into bite-sized pieces, so to speak. First being the employer stock plan. The XYZ stock is at a historic high. John has not exercised his non-qualified options. He has concentration risk with having roughly half of his investment portfolio in XYZ stock. And he has restricted stock. And Mary's been pushing for John to retire the end of 2021. And the reality is that if John and Mary are flexible in retiring and pushing that into 2022 for purposes of splitting the tax liability associated with and doing planning associated with exercise of non-qualified options over 2 years versus 1 year. That provides planning opportunities. Also, remaining just for 2 months into 2022, John will vest an additional restricted stock worth over $100,000 in value. So that is our highest priority. Second is looking at their overall portfolio. Concentration risk, not only in John's company, but also as it relates to being invested primarily in large cap US stocks and heavy weighting towards growth stocks. When we refer to an inefficient portfolio, an inefficient portfolio is a portfolio that is taking on more risk than it needs to based upon anticipated returns. And in this instance, they have a very high risk portfolio that needs to be addressed, starting out with identifying John and Mary's risk tolerance, their time horizon, et cetera, and coming up with what is a reasonable allocation strategy and investment plan that's in alignment with their goals. Next slide. In gathering information from John and Mary, we always, and clients in general, when we start an engagement, is to get as much information as possible, even though we may not be using it or addressing it in our the initial planning engagement, but it helps us to get our hands around their overall situation. And we had requested estate documents, and upon reviewing those documents, we discovered that John has not updated his will since he got divorced decades ago, and that his ex-wife is the primary beneficiary of his estate. Mary also has no will or trust in place as well. So again, in trying to prioritize, we believe that Mary may move this initiative to the top of the list, but really starting out and helping them to develop an estate plan and then implement that plan by getting documents in place to ensure that their goals, their plan is aligned with their goals. And lastly, risk management planning is really looking at liability as it relates to funding their goals, as it relates to long-term care, which Jeff had touched on earlier, et cetera, and just making sure that to the extent they're carrying insurance, it makes sense to be carrying insurance, and to make sure that, you know, we have planned accordingly for all possible contingencies. Okay, that concludes the case study. I'm going to turn it over to Jeff to take just a couple of minutes to wrap up and just touching on the reasons and the pitfalls of not establishing a financial plan.
All right, Wes, I appreciate that. I know it's Friday, so I'll certainly move along. But the great Chinese philosopher Confucius once said, "A man who does not plan long ahead will find trouble at his door." So if you don't have a financial plan, we implore you to act now. There's a lot of a lot of research around the negative consequences of not having a plan, or honestly, even worse, having a plan but not implementing it. Some of those negative things that research has found, things like having less savings and more debt, not properly identifying risk or addressing them. We call those the 3Ds: death, disability, divorce. Large investment losses, especially right before you need that money to fund some goal. Higher or unnecessary taxes, having to delay retirement, or even worse, not being able to retire at all. Weighing your kids down with debilitating college debt. Financial stressors definitely contribute to a lot of other problems in people's lives, things like marital problems, health problems, sleepless nights. Not having a plan a lot of times creates permanent procrastination. You just never take action. And last but not least, you're not able to attain your goals and dreams. So again, this cartoon here on the screen, I mean, it really does a good job of talking about what Wes talked about in the first slide he covered. When we have a plan with a client, it's just a snapshot in time. But stuff in their life happens, it's reality. And we're always continually updating the plans. So this is just a cute little cartoon that really explains that. All right, so I know all of your time is extremely valuable, so we really appreciate you chiseling out a half hour of your day to join us today. Hopefully you found this presentation helpful and informative. If you have any questions at all on this presentation or want to talk to one of our advisors about planning, please reach out to me and Wes. You see our contact information here, our emails, and our direct lines. And we'll either get back to you or we'll have one of the local advisors in your market get back to you. Again, we want to thank you again and hope you have a great weekend.